$30,000 in cashback feels profit-free until the IRS audits it. Then penalties multiply your mistake into a six-figure recalculation. Most small business owners don't know the IRS treats cashback and rebates as taxable income, not profit-neutral rewards. This assumption is costing entrepreneurs $5,000 to $50,000 plus in unexpected federal tax, accuracy penalties, interest, and IRS enforcement on business credit card arbitrage has accelerated dramatically since 2023. By the end of this video, you'll know exactly where the IRS flagged this first in 2024 audits, the 3 tax forms where this gets missed, and the one-line email to your CPA today that prevents you from becoming the next audit target. Let's start with the belief that's costing you thousands. You earn $20,000 in annual cashback on your business credit cards. You think, this is a personal reward. It reduces my cost, so it's profit neutral, no reporting needed. That's the trap. Here's what IRS Publication 525 actually says. Rebates and similar benefits are taxable income to the extent they represent a reduction in the cost of goods or services. If received as a lump sum, they are ordinary income and must be reported on Schedule 1 or Schedule C, depending on whether the activity is classified as a business or hobby. Treasury Regulation Section 161-1 is even broader. Gross income includes all economic benefits, whether received in money, property, or services. The delta is enormous. That $20,000 in cashback you didn't report. A 25% to 37% marginal tax rate, depending on your income bracket. You now owe $5,000 to $7,400 in federal income tax alone. But it doesn't stop there. The IRS applies a 20% accuracy-related penalty for underreporting, adding another $1,000 to $1,480. Add interest compounding at roughly 8% annually across multiple years, and you're looking at $6,500 to $9,000 plus in a single audit cycle. And that's if the IRS only catches 1 year. Here's where auditors flag this first. When the IRS pulls your 2024 return for review, they cross-reference 3 things. Form 1099-K, payment processor reporting, your Schedule C, business income, and your personal credit card statements. If you receive $20,000 in 1099-K cashback from your merchant processor or credit card issuer, but your Schedule C shows no corresponding line item or explanation, the return gets flagged for unexplained income discrepancy. Auditors then dig into whether you classified this as personal income reduction or business expense, and most owners haven't documented which. The second trigger is reporting threshold violation. Starting in 2024, many credit card issuers now file 1099 MISC or 1099-K for business cashback over $600. If you received a 1099 form but your Schedule C shows 0 adjustment, the IRS automated systems flag this as a mismatch. This is one of the fastest audit triggers in the current cycle. The third flag is hobby loss classification. If you're running cashback arbitrage across multiple cards, purchasing inventory, processing it, reselling, and capturing the spread, the IRS may reclassify your activity from business to hobby loss. Under hobby loss rules, you can only deduct expenses up to your hobby income, which means all that arbitrage profit becomes non-deductible personal expense. This wipes out your entire strategy and creates 6 figures in recalculations if you've been filing it as a business for multiple years. So how do you report this correctly? If the cashback is tied to business purchases, office supplies, inventory, travel, it should reduce the cost basis of that expense on your Schedule C. Don't add it as income. Subtract it from the expense line item. If the cashback is a standalone lump sum, like a cashback bonus from opening a new card, it's ordinary income. Report it on Schedule 1, Line 8, Other Income, or fold it into Schedule C if you're a sole proprietor running an active arbitrage business. The documentation standard now required by IRS auditors is clear. A spreadsheet or ledger showing which cashback came from which cards, which transactions triggered it, and how you classified it, business reduction or personal income. If you can't produce this in an audit, the IRS defaults to personal income not reported, worst case scenario. If you've already filed without reporting cashback, you have options. An amended return, Form 1040X, filed proactively before an audit notice buys you goodwill with the IRS and often reduces penalties. Filing voluntarily also stops the interest clock from the original due date, not the amendment date. Your credit profile is your leverage. Protect it.